Most traders don't lose because they're wrong. They lose because they're late. That may sound unfair at first. After all, if your idea is correct, shouldn't timing be secondary? Shouldn't the market eventually reward you for being right? But let me ask you something. How many times have you entered a trade, watched it move slightly against you, felt pressure build, and then exited, only to see it go exactly where you expected afterward? So were you wrong, or were you simply late? Watch your own behavior closely, not your wins, the losses. You'll notice something subtle, almost uncomfortable. You tend to enter after the move feels obvious, after the breakout is already underway, after the candle looks strong, after confirmation has already been priced in. Why? Because certainty feels safe. But markets don't reward comfort, they charge for it. Have you ever noticed how the best-looking trades often give you the worst entries? Clean breakouts, strong momentum, everyone agreeing, yet your stop gets hit almost immediately. Why does that happen? Because by the time it looks good to you, it has already been good for someone else. Let's break this down. An early entry is uncomfortable. It's taken when the signal is still forming, when doubt exists, when the market hasn't fully revealed its hand. A late entry is comfortable. It's taken after confirmation, after movement, when the narrative feels clear. But here's the trade-off no one explains properly. Early entries risk being wrong. Late entries risk paying too much. Which risk are you choosing? When you enter late, your stop must go wider, because price has already moved. That increases your risk. At the same time, your potential reward shrinks, because part of the move is already gone. So now you have a worse risk to reward profile, and you're entering when early participants are already considering taking profits. Do you see the imbalance? You're buying where others are selling. You're entering where pressure begins to shift. And then you wonder why the trade feels heavy. This isn't just technical. It's psychological. Late entries are driven by a need for reassurance. You want the market to prove you right before you commit. But think about that carefully. If the market has already proven the move, what edge is left for you? Are you participating or reacting? There's a difference. Professional traders don't wait for comfort. They anticipate. They position themselves where the risk is smallest, not where the story is clearest. So let me ask you, are you trading your analysis, or are you trading your emotions? Because waiting for confirmation often isn't discipline. It's fear wearing a suit. Let's connect the dots. Price moves in phases: accumulation, quiet, uncertain, expansion, fast. Obvious, distribution, exhaustion, reversal. Where do most traders enter? Phase 2, the expansion. The most visible, most exciting part. But here's the problem. Phase 2 is also where early traders begin managing risk. Some scale out, some tighten stops, some prepare for reversal. So when you enter late, you're stepping into a battlefield that's already been fought. And then what happens? A small pullback feels like a threat. Your stop gets hit. You exit. Then price continues. Not because the idea was wrong, but because your timing placed you on the wrong side of the cycle. So what's the solution? It's not about being early for the sake of it. It's about being positioned where risk is defined and controlled. Start asking better questions. Where is the market before the move becomes obvious? Where is uncertainty still present? Where would I be proven wrong quickly if I entered here? That last question is critical. An early entry allows for a tight stop, a clear invalidation point, a controlled loss if you're wrong. A late entry doesn't give you that luxury, so instead of chasing strength, begin observing structure. Look for consolidation zones before expansion, failed breakdowns or breakouts, areas where liquidity has been swept, but direction hasn't yet fully committed. Why these areas? Because they represent imbalance before it becomes visible. Here's a shift you need to make. Stop asking, "Has this move confirmed?" Start asking, "Where was the opportunity before confirmation?" That's where professionals operate. But let me challenge you. Why is that uncomfortable? Because it requires accepting uncertainty. It requires being wrong more often, but losing smaller when you are. Can you handle that trade-off? Because that's the real cost equation. Early entries, more frequent small losses. Larger controlled wins, late entries, fewer entries, but larger losses and inconsistent outcomes. Which one builds consistency? Your edge is not prediction, it's positioning. If you consistently place yourself where the risk is smallest and the potential is largest, outcomes begin to stabilize. Not because you're always right, but because your losses are controlled and your wins are allowed to expand. But if you continue entering late, you invert that equation. You risk more to make less, and that's not a strategy, that's a slow bleed. So next time you see a strong move and feel the urge to jump in, pause. Ask yourself, am I entering because I understand the setup or because I'm afraid of missing out? That question alone can change your behavior, because the market doesn't punish mistakes. It punishes hesitation disguised as patience. And if you start to recognize that your timing, not your analysis, is what's quietly draining your performance, then you begin to see that the real problem was never about finding better trades. It was about learning to step in before the crowd feels safe enough to follow, and that realization, if you sit with it long enough, starts to open up another question entirely. How do you actually train yourself to act in that uncomfortable window, when everything in you is telling you to wait just a little longer, and yet that little longer is exactly what keeps costing you? Comfort in trading feels like safety, but in reality, it's often a hidden cost you pay without realizing it. Think about when a trade feels easiest to take. The chart looks clean, the direction is obvious, momentum is strong, and maybe even others are talking about the same move. Everything aligns, and for a moment, it feels like the market is finally cooperating with you. But pause for a second. If it feels this clear to you, how many others are seeing the same thing? That's where the cost begins. By the time a trade feels comfortable, the market has already moved. The uncertainty that once existed has been reduced, and that reduction in uncertainty is exactly what you're paying for. Price has adjusted. The opportunity has been partially consumed. You're no longer early. You're stepping in after the initial imbalance has already played out. So what does that do to your position? It forces you into a weaker trade location. Your stop has to be wider because price has already extended. Your upside is smaller because part of the move is gone. And more importantly, you're entering at a point where earlier participants may already be thinking about taking profits or protecting gains. Have you ever noticed how often a trade looks perfect right before it pulls back? That's not coincidence. That's positioning. When traders seek comfort, they naturally gravitate toward confirmation. Strong candles, breakouts, visible momentum. But those signals don't appear at the beginning of a move. They appear after it has already started. And when you act on them, you're not initiating the move, you're reacting to it. There's a subtle but important difference between the two. Initiating comes with uncertainty, but it offers control. Reacting comes with clarity, but it removes your advantage. So ask yourself, are you trading to feel right, or are you trading to be positioned well? Because comfort feeds the need to feel right. It gives you emotional reassurance. It reduces doubt, but markets don't operate on emotional comfort. They operate on imbalance, timing, and behavior. When you prioritize comfort, you unknowingly align yourself with the crowd. And the crowd, by nature, arrives late. Not because they lack intelligence, but because they wait for clarity before committing. And clarity, in markets, is expensive. It's built into the price. That's why comfortable trades often feel heavy. You enter, and instead of moving smoothly in your favor, price hesitates. It pulls back. It tests your patience. Suddenly, the same clarity that convinced you to enter begins to feel uncertain again. Why? Because you entered at a point where the easy part of the move was already over. Early participants had the advantage of location. They could withstand fluctuations. They had room. You, on the other hand, entered where every small movement feels significant because your margin for error is smaller. This is where most traders get trapped. They believe they need more confirmation to reduce risk. But in doing so, they actually increase it. They sacrifice positioning for reassurance. They trade better looking setups, but with worse conditions. And over time, that imbalance compounds. You don't need to eliminate comfort entirely, but you need to recognize what it costs you. Every time you wait for the market to feel safe, you're giving up a portion of the opportunity. You're paying in distance, in risk, and in timing. So the real question becomes, can you learn to operate when things are not fully clear? Because that's where the better trades exist. Not in chaos, but in controlled uncertainty. In areas where the structure is forming, not where it has already played out. Late entries create a quiet imbalance that most traders don't recognize until it's already working against them. When price has already moved, the distance between your entry and a logical stop naturally increases. You're no longer entering near the origin of the move. You're entering after it has extended. That forces you to either accept a wider stop or place a tight one in a weak location. Which one do most traders choose? They compromise. They place a stop that's too tight for the structure, hoping the trade will continue immediately. And when it doesn't, they get taken out, not because the idea failed, but because the entry left no room for normal movement. At the same time, your potential reward shrinks. If a move has already traveled a significant distance, how much is realistically left? Even if the direction is still valid, the remaining upside is smaller compared to what was available earlier. So now you're risking more to make less. That's the core problem. Risk expands. Reward contracts. And yet, it doesn't feel that way when you're in the moment. It feels like you're entering strength. It feels like you're aligning with momentum. But momentum, when it becomes obvious, is often closer to its midpoint, or even its end, than its beginning. Have you ever entered a trade that looked strong, only to see it stall almost immediately? That stall isn't random. It's often the result of opposing forces beginning to balance out. Early participants start reducing exposure. New participants step in late. The flow shifts from expansion to hesitation, and you're caught right in the middle of it. This is where emotional pressure builds. Because your entry is late, every small pullback feels threatening. Price moves slightly against you, and suddenly, you're questioning the entire idea. You don't have the cushion that early entries provide. You don't have the psychological comfort of being in profit quickly. So what happens next? You either exit too early to avoid loss, or you hold on while hoping the market continues, even though your positioning has already weakened your control over the trade. Late entries don't just affect numbers. They affect behavior. They force you into reactive decisions. You become sensitive to every tick. You watch the trade more closely, not because it matters more, but because your margin for error is smaller. And that pressure leads to inconsistency. Now consider the opposite. An early entry allows you to define risk clearly. You're closer to the structure. Your stop can sit at a logical level without being excessively wide. If you're wrong, the loss is small and controlled. If you're right, you capture a larger portion of the move. So the equation shifts. Risk contracts. Reward expands. But this comes with discomfort. Early entries don't look obvious. They don't feel certain. That's why most traders avoid them. They prefer the clarity of a developed move, even if it means sacrificing positioning. So ask yourself, are you choosing clarity over efficiency? Because late entries are efficient for your emotions, not for your capital. They make you feel aligned with the market, but in reality, they place you at a disadvantage. You're entering when the easy opportunity has already passed, when the structure is no longer in your favor, and when your trade depends more on continuation than on positioning. And continuation is never guaranteed. This is why two traders can have the same idea but completely different outcomes. One enters early, accepts uncertainty, and gains control over risk. The other waits, enters late, and inherits all the disadvantages of timing. Same direction, different result. Not because one was smarter, but because one understood that where you enter determines how the trade behaves. The trades that look the cleanest are often the ones that offer you the worst position. It seems backward at first. You're taught to look for clarity, clean breakouts, strong candles, clear trends. When everything lines up visually, it feels like that's exactly when you should act. But think about it carefully. If a setup looks perfect, who else is seeing it? Everyone. And when everyone sees the same thing, the opportunity is no longer hidden. It's already been acted on. That clean breakout you're watching didn't just appear out of nowhere. It was built over time. Positions were accumulated quietly. Orders were filled when price was less obvious, when the structure was still forming, when uncertainty kept most people away. By the time it looks clean to you, it's already been in motion. So when you enter at that moment, you're not stepping into the beginning of a move, you're stepping into its visibility. Have you ever noticed how often price breaks out cleanly, pulls you in, and then immediately pulls back? That pullback feels like a trap, but it's often just a shift in participation. Early traders, the ones who built positions during less obvious conditions, begin to manage risk. Some take partial profits, others adjust stops. Meanwhile, new traders enter based on the breakout. That overlap creates friction, and you're entering right into it. This is why the best-looking setups can feel the most frustrating. They promise clarity, but deliver instability. Not because the market is random, but because your entry is competing with opposing intentions. You're buying where others are selling. You're entering where the balance of pressure is no longer one-sided. That's what makes the setup look clean. The move has already proven itself. But that proof comes at a cost. The cost is your position. Now think about how different it feels to enter before that clarity appears. It's uncomfortable. The structure isn't fully confirmed. The move hasn't expanded yet. There's doubt, and because of that doubt, most traders stay away. But that's exactly where positioning improves. When you enter before the move becomes obvious, you're closer to the source of the imbalance. Your risk is smaller because your stop can sit near a logical invalidation point. Your reward is larger because the move hasn't unfolded yet. You're not chasing, you're anticipating. So why do traders avoid this? Because clean setups remove emotional tension. They give the illusion of control. You feel like you're making a logical decision, supported by visible evidence. But in markets, visible evidence often reflects past action, not future opportunity. So let me ask you, are you reacting to what has already happened or positioning for what is about to happen? Because the cleaner the setup looks, the more likely it is that you're reacting. And reaction in trading comes with a delay. That delay is where the disadvantage lies. It shows up in subtle ways. Slightly worse entries, slightly wider stops, slightly reduced targets. Each one seems small on its own, but together they shift the entire outcome of the trade. You may still be right about direction, but your execution works against you. And over time, that creates confusion. You start questioning your strategy because the setups look correct. The analysis makes sense, but the results don't match the expectation. So you look for better indicators, better confirmation, better filters, without realizing that the issue isn't what you're seeing, but when you're acting. Clean setups attract attention. Attention brings volume. Volume brings competition, and competition reduces edge. That's the part most traders overlook. An edge rarely exists where everything is obvious. It exists where fewer people are willing to act. Not in chaos, but in areas where structure is still developing and participation is limited. So the next time a trade looks almost too perfect, take a step back. Ask yourself, if this is so clear, why wasn't I interested earlier? Most traders believe that being right about direction is what determines success. If the market goes up and you bought, you were right. If it goes down and you sold, you were right. But then a strange pattern appears. You can be right about direction and still lose money. How does that happen? It happens because timing quietly overrides accuracy. Think about a simple scenario. You identify a bullish setup. The structure makes sense, the trend supports it, and eventually, price does move higher, exactly as you expected. But your entry came after the initial move. Price pulls back, hits your stop, and then continues upward without you. Were you wrong? No, your timing was. That distinction is critical because most traders respond to that situation by questioning their analysis. They assume the idea was flawed when in reality, the positioning was. And that leads to a cycle, constantly searching for better predictions, sharper signals, stronger confirmation, without ever addressing the real issue. Let me ask you, how often do your trades fail immediately after entry, but succeed shortly after you exit? That's not coincidence. That's timing misalignment. When you enter too late, you place yourself at a point where normal market behavior works against you. Even in a valid trend, price doesn't move in a straight line. It breathes. It pulls back. It tests levels. If your entry is poorly timed, those natural movements become threats. You get stopped out not because the market disagrees with you, but because you entered at a point where you couldn't tolerate normal fluctuation. Now consider the opposite. If you enter earlier, closer to the beginning of a move, you gain something subtle but powerful: room. Room for price to move. Room for minor pullbacks. Room for the trade to develop. You're no longer depending on immediate continuation. You're positioned to withstand the process. So which trader is actually in control? The one who needs the market to move right away, or the one who can let the trade breathe? That's where timing changes everything. Accuracy predicts direction. Timing determines experience. A well-timed trade feels stable, even when price fluctuates. A poorly timed trade feels stressful, even when the direction is correct. And over time, that stress affects decision-making. You exit early. You hesitate on re-entry. You second-guess your setups. Not because your ideas are wrong, but because your timing keeps putting you in vulnerable positions. This is why two traders can read the same chart, reach the same conclusion, and still have completely different results. One enters where risk is defined, where invalidation is clear, where the structure supports the trade. The other waits for confirmation, enters after the move, and inherits all the instability that comes with it. Same analysis, different timing, different outcome. So ask yourself, are you trying to be right, or are you trying to be effective? Because those are not the same thing. Being right satisfies the ego. It proves that your understanding of the market is correct. But trading isn't about proving yourself right. It's about positioning yourself in a way that allows your ideas to play out without unnecessary pressure. And that requires a shift. Instead of focusing on where the market is going, start focusing on where you are entering relative to that move. Are you early enough to define risk properly? Are you positioned before the majority recognizes the opportunity? Or are you stepping in after the move has already validated itself? Because once a move validates, your role changes. You're no longer participating in the formation. You're reacting to the result. And reacting always comes with delay. Early entries feel uncomfortable because they force you to act before the market has made its intentions obvious. There's hesitation, doubt, and a quiet question in the back of your mind: what if this doesn't work? That uncertainty is real. You're stepping in when the move hasn't fully revealed itself, when the structure is still forming, when there's no clear confirmation to lean on. And because of that, it feels risky. But look closer at what you're actually buying in that moment. You're buying access to the beginning of the move. You're buying proximity to the source of imbalance. You're buying a position where your risk can be clearly defined and kept small. So while it feels uncertain, it's controlled. Now compare that to a late entry. The market has already moved. The direction is clearer. Momentum is visible. It feels easier to act because the doubt has been reduced. You're no longer guessing. You're confirming. But what are you really stepping into? You're stepping into a move that has already consumed part of its potential. You're stepping in where early participants are already in profit. You're stepping in at a point where the move may be closer to slowing down than speeding up. That's what exhaustion looks like. Not always a reversal, but a reduction in efficiency. Have you ever noticed how strong moves begin with hesitation, then accelerate, and then start to lose momentum, even while continuing in the same direction? That last phase is where most traders enter. It still looks strong. It still appears valid. But internally, the conditions are changing. The imbalance that drove the move is no longer as fresh. The urgency begins to fade. And you're entering right as that shift begins. So ask yourself, are you buying strength, or are you buying what's left of it? Because there's a difference between a move that is starting and a move that is continuing. Early entries align with initiation. Late entries align with continuation. And continuation always carries more uncertainty than it appears. Why? Because continuation depends on new participation. It requires fresh buyers or sellers to keep pushing price forward. But by the time a move is obvious, a large portion of participants have already acted, so the pool of new entrants begins to shrink. At the same time, early participants begin to manage their positions. Some reduce exposure, some lock in profits. That creates opposing pressure, subtle at first, but enough to slow the move. This is where exhaustion builds, not as a sudden collapse, but as a gradual loss of momentum. The move still exists, but it becomes less efficient. It requires more effort to produce smaller results. And if you're entering late, that inefficiency becomes your problem. Your trade needs the market to continue performing at a high level, even though the conditions are no longer as favorable as they were earlier. You're depending on something that is already weakening. That's why late trades often feel inconsistent. Sometimes they work, but not smoothly. They stall, they pull back, they test your patience. Other times they fail quickly, not because the direction is wrong, but because the timing exposed you to a phase where the move was no longer strong enough to support your position. Now go back to the early entry. Yes, it feels uncertain, but that uncertainty exists because the move hasn't yet attracted widespread participation. There's less competition, less crowding, more space. You're not chasing, you're positioning, and that positioning gives you an advantage. Your stop can be placed logically and tightly. Your potential reward is larger because the move hasn't expanded. Your expectations are aligned with development, not continuation. So the discomfort isn't a flaw, it's a signal. It tells you that you're operating in a phase where opportunity still exists, where the move is not yet obvious, where the imbalance is still forming. Strong moves attract attention. That's their nature. When price begins to move with speed and clarity, it becomes visible. Charts look clean, direction feels obvious, and suddenly more traders start paying attention. What was once quiet becomes active. What was once uncertain becomes convincing. And that attention brings participation. But here's the part most traders overlook. Attention doesn't just bring opportunity, it brings distribution of risk. Think about how a strong move begins. It rarely starts with excitement. It starts quietly. Positions are built when price is still ranging, when the direction isn't fully confirmed, when most traders are waiting. That's where the advantage is created. Early participants take on uncertainty, but in return, they gain better positioning. They enter closer to the source of the move, with tighter risk and greater upside. They don't need the market to prove itself immediately because their entry allows for fluctuation. Now fast forward to when the move becomes strong and obvious. Momentum increases, breakouts occur, volume expands, and this is where attention peaks. So let me ask you, what happens when more traders start entering the same direction at the same time? It feels like strength is building, but something else is happening beneath the surface. Risk is being transferred. Early participants, who are already in profit, begin to manage their positions. Some scale out, some take partial profits, others adjust their exposure. At the same time, new traders are entering based on the visible strength. That creates an exchange. The risk that early traders carried is now being passed to late entrants, and you don't see this directly. It shows up in behavior. Have you ever entered a strong move, only to feel like price suddenly slows down or becomes unstable? That's not random. That's the result of opposing actions happening at the same time. New buyers step in, while earlier buyers begin to step out. The imbalance that once drove the move starts to weaken, not because the direction is wrong, but because participation is shifting. So even though the move still looks strong, its internal structure is changing. And you're entering right into that transition. This is where confusion begins. Because from the outside, everything still looks aligned. The trend is intact, momentum is visible, the breakout is clear, but the behavior becomes less efficient. Price doesn't move as smoothly, it hesitates, it pulls back more frequently. Why? Because the easy part of the move, the part where imbalance was strongest, has already passed. Now the market requires continuous new participation to maintain the same level of momentum, and that's not always sustainable. So when you enter during a strong move, you're not just trading direction. You're trading timing within that participation cycle. Are you entering when imbalance is building or when it's being distributed? Because those are very different conditions. When imbalance is building, price moves with less resistance. There's fewer opposing forces. The move develops naturally. But when imbalance is being distributed, price still moves, but with more friction. Every push meets some level of opposition. And that friction affects your trade. You feel it in the form of slower progress, deeper pullbacks, and less predictable behavior. Even if the trade eventually works, the path becomes more difficult to manage. Now consider what this does to your decisions.